SpaceX jumped 2.6%. Moat scores 78 out of 100. High durability. Beyond basic booster reusability, Starlink now operates over 6,000 active low Earth orbit satellites, generating recurring high-margin revenue. Vertical integration cuts internal payload launch costs below $1,500 per kilogram. Our complete teardown reveals how this massive orbital infrastructure creates a structural advantage competitors cannot match. What operating evidence matters most for Space Exploration Technologies Corporation? The moat isn't just booster reuse. And another question, what could weaken Space Exploration Technologies Corp's moat durability? The operational execution of its direct-to-cell satellite network establishes a key first-mover advantage over legacy satellite operators, leveraging continuous booster reuse to lower payload insertion costs to orbit. SpaceX sits as a Tier 1 bottleneck in the AI supply chain. The AI compute infrastructure layer, currently in a rising phase. Tesla just reported a significant gain on its equity stake in SpaceX, sending shares of SPCX up 2.6% to $118.24. That single accounting line item puts SpaceX right back at the center of every market terminal on Wall Street. Yet behind this immediate headline pop, the broader market is pricing in a massive narrative divergence. Investors are desperately trying to revalue a traditional aerospace titan as a next-generation utility powering both global telecommunications and defense artificial intelligence infrastructure. Capital is actively seeking exposure to high-moat compute networks, but traders remain hesitant following recent broad weakness across industrial and technology sectors. While short-term retail momentum is reacting to Tesla's balance sheet adjustment, institutional order flow is probing whether SpaceX can transition from a dominant launch provider into a high-margin data backbone. The real story isn't the paper gain recorded by an affiliate company. The real story is whether public equity markets are willing to underwrite a $1.6 trillion valuation for a company expanding its capital expenditure profile into orbital infrastructure while facing broader macro headwinds. Evaluating SpaceX requires looking past accounting adjustments to the physical constraints of orbital hardware. Operating high-density compute clusters in low Earth orbit creates a severe thermodynamic bottleneck. Heat dissipation in a vacuum relies strictly on radiative heat transfer, the transfer of energy through electromagnetic waves without direct atomic contact, because convective airflow does not exist in space. Standard terrestrial data centers deploy massive liquid-to-air cooling systems, but an orbital server array running top-tier accelerators must radiate roughly 1 kilowatt of thermal load per square meter of panel area at elevated operating temperatures. Furthermore, payload capacity directly governs deployment economics. A single Falcon 9 rocket delivers approximately 22.8 metric tons of payload to low Earth orbit in a fully expendable configuration, whereas a competing Blue Origin New Glenn rocket targets 45 metric tons to low Earth orbit. However, SpaceX counterbalances raw payload differentials with unmatched launch cadence and booster reuse economics, completing tens of refurbishments on individual cores to lower marginal launch costs. Terrestrial hyperscalers like Amazon AWS operate low-latency fiber networks with unlimited atmospheric cooling access, placing orbital compute at a stark thermodynamic disadvantage for heavy artificial intelligence model training. Until radiator surface area constraints and radiation hardening yields are solved at industrial scale, the hardware reality indicates that orbital compute remains a long-horizon engineering experiment rather than an immediate revenue catalyst, leaving the core launch and satellite broadband services to support the existing business valuation. Quarterly financials showing modest revenue momentum for SpaceX. Federal Reserve monetary policy sits directly at the center of SpaceX's capital allocation strategy. With the benchmark federal funds rate, the central bank interest rate that dictates commercial lending costs across the economy, holding at 3.63% and the 10-year Treasury yield standing at 4.67%, capital intensity carries a real cost. The normalizing yield spread, the difference between long-term and short-term government bond yields, of plus a modest percent signals a macro environment where long-term debt financing requires rigorous yield justification. For SpaceX, High long-term interest rates raise the cost of capital needed to construct automated rocket manufacturing facilities and deploy massive satellite constellations. Prediction markets like CalSure currently price trailing 12-month recession risk at a modest percent, offering third-party context that macroeconomic panic is low, yet elevated borrowing costs exert steady financial drag. Simultaneously, policy dynamics present a powerful structural tailwind. The company sits as a primary candidate for inclusion in major indexes like the S&P 500, the benchmark index tracking 500 of the largest American public companies, and the NASDAQ 100, the index comprising 100 of the largest non-financial companies listed on NASDAQ. As a recent megacap listing with a market capitalization of $1.558 trillion, passing standard seasoning criteria will trigger mandatory asset allocation from passive index funds like SPY and QQQ. Passive fund managers will be legally required to acquire tens of billions of dollars in SPCX equity to match index weightings, creating a predictable structural buying window that absorbs secondary market supply, regardless of daily economic sentiment. Geopolitical competition acts as a primary revenue accelerator, cementing SpaceX as an essential sovereign asset. U.S.-China space domain rivalry has forced the United States Department of Defense to treat orbital infrastructure as critical national security terrain. Sourced federal contract data confirms SpaceX holds $9.8 billion in active federal contract awards over the past 12 months. The NASA backbone accounts for $6.63 billion across major crew and lunar lander programs, while the Department of Defense represents $3.19 billion across national security launch programs, including a recent $541 million Phase 3 Lane 1 contract. These long-term government commitments establish a non-cyclical revenue baseline that isolates the business from commercial downturns. Overseas trade tensions, including proposed 50% tariffs on Canadian imports and stalled bilateral trade agreements, introduce raw material supply chain complexity, yet national defense priority guarantees regulatory backing. On the social and regulatory front, SpaceX is executing a massive pivot from standard satellite broadband to direct-to-cell space communications. By partnering with major wireless carriers, the network turns standard civilian smartphones into satellite terminals without specialized hardware modifications. While consumer sentiment toward megaconstellations involves debates over light pollution and orbital debris management, the public safety benefit of global zero-dead zone cellular coverage provides massive socio-political leverage. Macro forces present operational friction through elevated interest rates, but defense imperatives and index inclusion mechanics supply an undeniable structural tailwind. SpaceX, AI compute infrastructure, is trading below its 20-day average. Management's headline is not about reusable rocket boosters or satellite internet deployment. It is about truth-seeking artificial intelligence. In SpaceX's 424B4 filing, the official post-IPO prospectus registered with the Securities and Exchange Commission, management cited the word AI 868 times, outnumbering launch at 840 times, and leaving government trailing at just 283 mentions. The company explicitly defined its core mission as advancing humanity's understanding of the universe through artificial intelligence, explicitly anchoring its corporate taxonomy to Grok API, Grok Business, Grok Enterprise, Grok Voice, Imagine, and high-density compute, processing power packed into a tight physical space with extreme power demand per unit of area. This linguistic engineering is surgical. By steering the narrative away from aerospace logistics and toward high-density AI infrastructure and real-time inference, the live execution phase where an AI model generates responses from new input data, management is asking Wall Street to price the equity as a high-margin software and compute utility rather than a capital-intensive defense and satellite contractor. The prospectus commits roughly $74.4 billion in net IPO proceeds toward expanding AI compute infrastructure alongside launch and satellite capacity. What management wants you to see is a sovereign AI compute engine. What the PR filter reveals is a deliberate effort to capture software-style valuation multiples. No qualifying executive statement in the last 6 months appears in official transcripts to clarify this transition beyond the written prospectus. That silence is enforced by post-IPO lockup agreements, contractual provisions preventing pre-IPO insiders and early employees from selling equity immediately after listing. However, pre-IPO lockup expirations will bring approximately 911 million shares onto the market, potentially doubling the public float, the volume of shares available for open public trading. That impending supply influx creates a structural overhang that glossy press releases cannot mask. While the corporate narrative focuses on AI infrastructure, capital flows reveal how key market participants are positioning ahead of the lockup release. Concurrently, FINRA short volume, the daily percentage of total market share volume executed by short sellers, sits at 66.5%, closely tracking its baseline of 66.9%. This indicates normal hedging activity rather than a speculative short attack. Institutional 13F filings. The quarterly regulatory reports detailing institutional fund manager holdings are not yet established due to the recent listing 41 days ago, leaving a structural data gap that reflects listing recency rather than institutional rejection. The fundamental gap between the PR narrative and physical reality lies in thermodynamics. Management's prospectus frames space-based data centers as the ultimate solution to land and terrestrial power constraints. However, in orbital space, convective air cooling is physically impossible. Dissipating heat from high-density graphics processing units must rely entirely on radiative heat transfer, the process of emitting thermal energy as infrared radiation directly into a vacuum, which requires massive radiative surface areas that add payload weight and reduce net compute efficiency. A close review of quarterly language shifts shows management introduced growth 3 times and record 1 time into official disclosure text, shifting focus to top-line expansion while masking long-term capital intensity. If AI infrastructure CapEx exceeds 50% of total capital spending without demonstrated orbital thermal dissipation benchmarks, the narrative pivot collapses into an overhead burden. What management calls an AI transformation, the lab recognizes as a high-stakes valuation stretch. The momentum breakdown for SpaceX. RSI sits at 16, pointing to oversold territory, potentially setting up a bounce. MACD is currently bearish, with downward histogram pressure. The Moat isn't just booster reuse. It's full vertical integration from engines to user terminals. By producing rocket engines, satellite chassis, and phased array user terminals in-house, the company achieves unit economics that terrestrial aerospace competitors cannot duplicate. The operational execution of its direct-to-cell satellite network establishes a key first-mover advantage over legacy satellite operators, leveraging continuous booster reuse to lower payload insertion costs to orbit. However, severe structural challenges threaten this hardware narrative. What SpaceX is saying, backlog and Starlink cash flow justify valuation. What the lab hears, orbital compute physics caps near-term scale. The equity currently trades at a forward P/E, price to earnings, a metric comparing current stock price to projected future earnings, of elevated times, leaving zero room for execution errors. The technical chart exhibits a descending channel with lower highs, testing key support at a level against resistance at $172. Furthermore, the upcoming lockup expiration, the contractually mandated period preventing pre-IPO insiders from selling shares, on December 9, 2026, presents significant forward supply risk as early holders gain liquidity. Daily tracking shows Cathie Wood's ARK Invest actively accumulating across ARKK, ARKQ, and ARKW, bringing total holdings to $429 million. Yet institutional 13F filings, quarterly regulatory disclosures of equity holdings by institutional investment managers, reflect past quarter positioning rather than real-time conviction. Can SpaceX's government contract backlog and commercial Starlink revenues generate enough operational cash flow to service its expanding debt load following its bond sale? Or will orbital data center physics prove too capital-intensive to deliver viable return on invested capital? The lab's engineering analysis confirms that while launch frequency and broadband revenue provide immediate cash generation, orbital compute infrastructure faces severe radiative cooling limits that prevent near-term deployment at commercial scale. If SpaceX maintains its Starship flight test cadence while expanding its government contract backlog above $10 billion, it proves that its core launch and communications business can support its mega-cap valuation regardless of speculative orbital compute timelines. If regulatory flight halts or launch pad damage delay Starship progress past 12 months, it reveals that capital expenditure requirements will erode gross margins and force further debt issuance. Sourced U.S. spending contract data tracking NASA and defense awards remains the definitive operational metric to monitor. The lab assigned SpaceX a Moat durability score of 78, reflecting exceptional core execution balanced against severe orbital compute physics constraints and valuation overhang. The case against this thesis, the forward P/E leaves zero room for execution errors. Here's the macro picture shaping SpaceX. High interest rates currently increase the cost of building massive rocket factories, while new federal launch licensing rules are slowing down the frequency of Starship flight tests. These regulations matter because any delay in government approval prevents the company from launching the satellites needed to fulfill its multi-billion-dollar defense contracts. The company is currently shifting from simple satellite internet to a global cellular network that acts like a giant cell tower in space for ordinary smartphones. This technology gives them a massive lead over competitors like Blue Origin, who are still struggling to reach orbit with a comparable heavy-lift vehicle that can carry such large payloads. The next 6 months hinge on the first successful landing of the Starship booster back at the launch site, which would prove that the world's largest rocket is fully reusable. However, a single failed launch that damages the only operational launch pad in Texas could halt all operations and delay the entire NASA Moon mission timeline by over a year. SPCX's 78 durability score isn't just a number. It's proof the supply chain finally trusts their thermal interface. Is the bull case or bear case stronger for SPCX? Drop your thesis in the comments. This isn't financial advice. We're here to break down the engineering, not tell you what to do. Markets move fast. Past performance doesn't predict the future, and you should always run your own numbers before pulling the trigger. If you want our full breakdown on Rocket Lab, the link is in the description. Subscribe so you don't miss Thursday's deep dive. We're tearing down SK Hynix. The lab's back. Stay sharp.